The agency hot seat. I am your host, Ryan Watson. I am rejoined once again by Meredith Pickrell. We are here. We are here to answer your questions. The format is very simple. You show up, you ask us what's on your mind. Could be finance, could be operational, could be horoscope. I don't care, whatever you got. We're here for the next 30 to 60 minutes, and we will give you our best answers based on our collective decades of experience advising agencies on just these very matters.
I think you
We,
missed your calling as like a game show host or like a radio host.
I know we did a team offsite once, and we did like a faux game show, and I was the host, and I felt really in my element. Yeah, I should be doing that. I look at Ryan Seacrest, and I think I could make $40 million a year, whatever he makes. Anyway, all right. So we've covered everything. Now we got to get to the meat, right? What do we got? What do we
Do
got
it.
on deck here? Caroline, of course. Oh, let me just cover one more thing. So Caroline is going to be our MC. She's going to feed us the questions. If you have them, drop them in the comments in LinkedIn as well as the comments on YouTube. I've not misspoken, right, Caroline? These are the instructions. Yeah, so put them in the comments. We've also, as we normally do, we get a flurry of questions throughout the weeks in anticipation of this session. And so we've got a few loaded in the hopper that we can work through while we wait on the live audience to chime in. So, all right, Caroline, whatever. What do you got?
All right, let's kick off. So our first question is, how do I create a good severance package?
How do I create a good severance package?
Unfortunately, this is something we've had to deal with a lot this year. A lot of our we're seeing a lot of layoffs in the industry. So it just depends. It depends on where your cash position is at right now. It depends on how long, like what you can
Yeah.
afford. It's really like what you can afford. Ultimately, like if your employee's been around longer, you want to be more generous on severance. If they're a newer employee, you don't have to be as generous on severance. I've seen anything from like as low as 2 weeks, as high as 12 weeks. 12 weeks is really high, and I would not recommend that for like a small agency. That is not the expectation. Most of the severance packages are falling somewhere in the 4 week range, is what I'm seeing. But again, very much dependent on cash.
Yep, I think I agree with all that. A couple of things I would add. One is create a policy, a severance policy up front. Especially it doesn't have to be. You occasionally see relatively complicated plans that tier with every year of seniority. You get a little more. I don't think it needs to be that much. I do like, as Meredith implied, um, like a cliff vesting, if you will. So, as in, like in your first X number of months or years, you're not eligible for severance at termination. And then once you hit that anniversary, you're eligible for the standard severance, 2 weeks, 4 weeks, whatever it is. As Meredith mentioned, it's really just a function of what you believe and what you have the sort of wherewithal to do. Um, the other thing I'll just say, just in terms of like, what do you have to do? I mean, if you find yourself in a situation where you have to do layoffs and you don't have a severance policy and you don't have a lot of money sitting around to cover some severance, I think you should be reminded that you're not required to pay severance in most states. And however, you are likely to want your clients to sign or reaffirm like any. So again, if you have your clients sign, or your employees rather, signing IP assignments, non-solicitations, those sorts of things, non-solicitation to clients, and you are going to pay them severance, I'd have them go ahead and reaffirm those covenants on the way out. And if you choose to do that, you have to pay them something for that to be legally binding. But technically speaking, it doesn't have to be more than a couple $100s. That's kind of all that is required for that to be consideration in a legal agreement. But anyway, yeah, no,
The other thing
no one size fits all. Yeah,
Oh, sorry. The other thing to
go ahead.
consider is a lot of states, depending on what your PTO policy is, a lot of states require you to pay out your PTO too. So when you're looking at making those terminations, and if you want to offer a severance package, also consider how much you have your liability for PTO payout. And then the other thing that I've seen recently too is like as you're making these decisions, the sooner you can make them, the better it is for everyone. Like the longer you drag out having to make that decision whether to terminate someone, it just, eats up what you're able to pay out to them in severance.
Totally.
So once you decide, make the decision and roll with it. Don't keep dragging your feet on it.
Totally. All right. I think we had that one surrounded. Caroline, what's the
Awesome.
next question?
So our next question is, my cash balance is above our target of 3 months burn on hand. What should I do with my excess cash? And are there any high yield accounts you see other agencies using?
Yeah, this is a hot topic right now with the agencies that are doing well that have liquidity on hand. There are some pretty high yield, we're seeing like 5%, 4 or 5% savings accounts, and so they're just opening one of the accounts and transferring it to it. The best thing to do is talk to your local, either your personal investment advisor, and decide, should I take this money out of the business? It's cleaner to take it out of the business and just go put it on the personal side. I do have clients that open it in the business's name and transfer it to if it's just a savings account in the business name, that's easier. If it's an investment account in the business name, it makes it trickier for tax purposes, but I won't claim to be an expert on advising on that piece of it, the tax side, but
Yeah, I mean, I have such a strong opinion about this, which is don't leave it in the business and do something with the business. It just doesn't, it doesn't make any sense. First of all, you're not in the business of speculating on or investing in long-term securities. Like that's not the core business. So if you don't have a need for the cash in the core business you're in, which is I'm going to invest in this new role, this new line of business, this marketing initiative, like if you don't have an ROI positive use of cash for the business and don't go searching for one, right? Like if you don't have it, you don't have it. Distribute the money to the partnership and then invest the money on your own behalf. And I say that from the standpoint of A, as Meredith mentioned, it is cleaner, like particularly if you have a multi-member situation, then it's just a lot easier for the individuals to make their own independent decisions. And number two, like from a tax planning perspective, like we have a lot more levers at our disposal on the personal side than we do at the company side. So you have all sorts of things you can do with that excess cash, like creating a STEP IRA or a solo 401k or other kinds of investments that you might choose to make, like in real estate that has both, cash flowing as well as tax advantages. All these options available to you that are much more interesting than, a high yield savings account that you should just make that decision independently of, right? So anyway, distribute the money to yourself, work with a wealth advisor, and make those choices on how to invest that money with them.
you just have to be, a lot of our S Corp owners leave the cash in the business to pay taxes out of, whether that's the right or wrong answer. You just have to be cognizant of like, if you're taking that money out of the business, you're going to have
Well,
to
I
pay.
mean,
Like,
yeah,
that's a,
totally. I assumed that this was sort of a true excess cash in the true sense. If this is temporary excess cash because it represents a future liability, like a tax payment, then siphon that off and just hang on to it and fine. High yield savings is fine. But if you truly have like excess cash, I'm
yeah.
looking for some longer term vehicle to invest and earn a return, distribute it to yourself, and that'll open up more options for you.
Yeah. We also have clients that have the high yield savings account that have that 3 months of their burn and sitting in it and just earning interest, and they're
Totally.
transferred. You
Why
just have
not?
to pay attention and transfer it back and forth to your checking account to make payroll. And you just have to play a little bit of a game there. But if you're watching it, you can make some money, like easy money off of that.
Yeah. It's not gonna light the world on fire. I'm not
Yeah.
even all that hot on those, but it's, if some people it's just kind of a principle based thing. Like it's why would I let this sit around and make free and
Yeah.
earn no money. So yep. All good. Okay. Good question. All right. We're off to a good start here. Caroline,
All right,
I think we're
kicking
ready
off
for
to
the next one.
question 3. Here's your quick reminder. If you are streaming in and you have a question, please feel free to drop it in the comments or the chat and we'll get to it. Otherwise, we'll keep rolling with the questions we've received over the weeks in between. So our next
Cool.
one is, how do I go about tracking LTV and CAC, and what is the best way to use these metrics?
Yeah, that's a good question. It kind of, well, did you have I saw this question ahead of time and I thought about it for a second. What's your Meredith? What was in your? Did you have an initial reaction to this?
Sorry.
LTV and CAC. I can at least. My initial reaction was, I don't think there are very many agencies that should be tracking this information. Like this is
Yeah.
these are so So to restate the question and then give a little context, the question is how do I go about tracking LTV and CAC and what's the best way to use these metrics? LTV stands for lifetime value, CAC stands for customer acquisition cost. These are traditionally SaaS or subscription-based revenue metrics. The idea being a subscription contract, of which SaaS is generally, has a long life, right? So a client today is going to be a client, for some longer term period of time, and that's valuable to me. And so I can pay more for that because I'm going to have it for a long time and it's a value, right? And so customer acquisition cost is how much it costs me to go out and acquire that, and that's like my sales and marketing cost divided by number of customers acquired kind of a thing. How much am I devoting to each new customer in the door? And how should I think about the relationship between lifetime value and customer acquisition cost? And in the SaaS world, the metrics are usually like 5 times. So if your LTV is 5 times or more greater than CAC, then you have a positive unit economic of the business, and you should just keep throwing money into the CAC machine and spitting out those customers. But very, very, very few agencies have the kind of business where they're perfectly subscription based. They have been doing it in a homogenous way for long enough that I could really like estimate LTV with any kind of confidence. Have defined enough, because again, CAC makes more sense when you have paid channels like search engine SEM, paid Instagram, Facebook ads, things like that. That's not really the traditional sales channel for agencies. So to whomever asked this question, I think what I would want to do is have a longer conversation about how you're thinking about your sales channel and maybe just kind of reframe it, because I'm not sure these metrics are going to help you. But I do think it is fair to think about how much I'm spending on sales and marketing as a percentage of revenue. There is a point at which it's just economically not viable. And CAC and LTV have kind of a cousin-like relationship to that idea. The difference being we're just talking about sales and marketing costs in 1 year and revenue generated 1 year, regardless of whether or not the life of that client extends into future years. And so, Meredith, I'd say about the highest that I've seen a business go in a healthy profit margin arena would be in the like 15% range for sales and marketing. But generally, like we'd like to see it lower. And most agencies don't spend anywhere near that.
No,
And
I believe
and yeah,
6%, and that's including sales and marketing labor plus actual marketing spend.
yeah. If you have and again, the reason is because traditionally agencies don't have sales teams. They have a business development person, maybe another person, but it's very bespoke, relationship oriented, team selling game. There's a big, heavy account management function. So a lot of your account manager, like people or client partners, are responsible for retaining revenue, upsells, whatever.
Yep.
If you sell the kind of now, but we do have agencies that have sales motions with sales teams because they sell a more productized offering, and that will have a higher cost to it, and that can get up to as much as 15%, and as long as the rest of the business makes sense, that can be okay. But yeah, to Mara's point, like if you have a more traditional sort of BD person, that's kind of it.
Yep.
Then south of 10 is where you should be.
Yep. Yep.
Cool. All right.
Okay, so we
Kara.
just had this question come in. It says, at the beginning of the year, we set a budget to hit a 20% operating profit, but so far through the first half of 2024, we've only generated a 10% operating profit. How should we approach the rest of this year to get closer to hitting 20% over the next 6 months?
I think this is just a math question, right? Is this like a train? Is this like if two trains leave two places going 60 miles an hour? I think it's just 30% in the back half and then it averages. Is that
Yeah, but like
I don't think that's what they're asking.
realistically,
I
that's
know.
not like you're not gonna do that.
Just
Like
kidding.
I would focus on a path to 20%. Like what do we need to do? What levers do we need to pull to be able to get us to 20% month over month for the rest of the year? And you're gonna net
Totally.
out sort of 15% or whatever your numbers are, but you're not gonna make up that much ground. And if you are, you're gonna burn out your team.
Yeah, totally. There's not a whole lot more to add to this other than I think the unstated thing that Meredith is saying, which I'll just state, is like ultimately your path to getting to 20% is your gross margin. Like the reason that you hit a 10%. I mean, I suspect it's if the reason that you hit a 10% and not a 20% is because you spent too much on overhead or other non-COGS related costs. Well, I have some wonderful news for you. This problem is very easy to solve. You just eliminate those costs, and voila, you are at your 20%. But that's never the story. The story is, I'm confident. I'm not talking to this founder, but I'm confident the story is we missed our revenue number, and because we missed our revenue number and we kept the team, we earned a lower gross margin, and that lower gross margin generated a lower operating profit. And so, toward the back half of the year, if you don't have crystal clear visibility into increased revenue, such that you can get your gross margin back to that. And when I say crystal clear, I mean like contracts at proposal stage or better, like booked revenue to a great degree. If you don't have crystal clear visibility, then the only other rational answer here is reducing the footprint of the sales team or of the service team such that you can get a gross margin back in your target area. And by the way, it's probably a little bit of both. I liked my answer first though. Just get 30% in the back half, and then
Yeah.
it'll even out. Then it'll even out. You just do it. And by the way, this is just a small soapbox topic for me. I see a lot of like thinkfluencers on LinkedIn with their like ratios of here's how to make an easy agency. It's just like here's my 50-30-20 rule or some version of that. Like, oh yeah, you just go out and you only spend 50% on COGS and then you spend 30 and then immediately you have 20%. It's just that easy. If you're not doing it, you must be silly. Like it's not it's not that easy. Like you're forgetting the part that's the hardest part, which is I have to generate consistent revenue in order to meet the it's just anyway, I just think it's very funny. Like you don't just snap your fingers and get 20%. It's actually quite hard. And it's ultimately a revenue generation and revenue retention game.
That reminds me of like the show that's like they're like it's the write-off people. You just write it
Oh
off.
yeah, it's the no, yeah, that was Schitt's Creek. Yeah,
Yeah.
you just write it off. I don't think you know how this works. Yeah, totally. Every time I see one of those posts, I'm like, don't respond, don't respond. I'm like, I always have to start to type out a thing and then I stop. So anyway, that was a good one though. Thanks for the live question. That was good. I like it. Hopefully, I'm wishing you a very good back half of the year and let us know how you get. It'd be great. Okay,
Awesome. So
Caroline.
our next one, we have what should we be thinking about going into the second half of the year? What best practices can we adopt to revisit a budget? Should we be revising our budget?
What do you think, Meredith?
Yeah, where my head is at is like, where were we at the first half of the year in your particular business? Like, how are things going? What visibility into sales and pipeline do we have in the latter half of the year? There still feels like the client conversations I've been having is there's a lot of uncertainty. Sales have continued to be really tough this year. And so I think overall, like, unless you're just totally crushing it on your margins, like continue to maintain like lower OpEx, like maintain expenses, like don't go out, like if we can not have a retreat this year and continue to, reduce your cost, and then focus on that sales pipeline. It just really depends on the business and how your business is doing and what visibility you have. Like some of our clients have really long visibility they can see out into Q1 right now, and other clients are so project based and they don't have as long of a visibility into what the latter half of the year looks like.
Yeah, I have a couple thoughts. I totally agree with everything you're saying too, by the way. That makes sense. I have a couple additional thoughts. One thought is, and I think I've talked about this on the hot seat in some form or another, but in general, and this is maybe like a somewhat controversial thing to say, but like in general, I don't think so. We have a lot of clients that create a forecast, I'll say, a version of a budget where they project sales going forward, and then they project costs that align to those sales going forward, and then they project some sort of profit, right? I don't think there's anything wrong with having a goal, like a sales goal. I would feel good if this happened, but I don't know that it's doing us an enormous amount of good creating these longer term forecasts for businesses that don't have the kind of repeatable sales engine where those forecasts have any merit or any legitimacy whatsoever, right? Like they're just numbers on a page. Boy, wouldn't it be cool if this happened? I certainly hope, again, if it's just the founder and we're mostly getting inbound word of mouth referrals, things like that. And sure, we're doing some outbound activities, but there's not a huge rhyme or reason to it, and there's no predictability to it. Then I just write numbers down on paper. And then when they inevitably don't happen, because why would they? Like it's just random, then I'm disappointed. I'm upset. I feel like a failure when it's like, well, I didn't. There are no. I didn't take. I didn't partake in the inputs that would drive the predictable outputs. Anyway, I just think the forecast exercise should be reserved for the kind of businesses that have a right to forecast. And I think the businesses that have a right to forecast are businesses that have repeatable revenue generation, some degree of predictability. And if you're not in that area, then I believe your budgeting exercise should simply be narrowed to the window of visibility. In other words, like how far out do I have line of sight to when I look at the revenue I have booked and the opportunities that I have in my pipeline right now? Go out as far as that. That's my revenue. Now, based on the things I have line of sight to, current customers, booked revenue, and pipeline, what should I do in that regard? What choices should I make with regard to my staffing increase, decreasing, whatever? And what outcome do I think I'm going to get based on what I have line of sight to and the choices I need to make based on that line of sight? And I think that's as far out as you should go. Any further, again, I just think you're setting yourself up for, at best, just kind of like a fruitless exercise, and at worst, just a mind fuck. It sucks.
Uh,
So
I
yeah,
I want to get your opinion on this. I of course have my own opinions, but something that has always come
yeah,
up, but especially right now is coming up. It's like I'm struggling to get work in the door, so I'm going to take on a project that is lower than what I should probably be taking on the project or the work for. Do you take on that project or do you say no to it?
yeah. I mean, well, remind me again. The assumption is it's lower than I normally charge, but it's like I'm gonna at least cost recover with my people.
I think. I
Yeah,
don't,
that's the idea.
yeah. Yeah.
Yeah, I mean, look, it's so funny. Every time I hear this question, I think back to I don't know, accounting 212 is what I think. I think that is the number. I'm gonna have to go back and check. Counting 212 case study on some like steel company that was basically the same question. Like, if I can sell at a variable marginal revenue such that I exceed my marginal cost, would I do it? And like the theoretical answer to counting 212 was, of course, of course. Why I have excess inventory and I can recover my cost at a minimum. Of course, I would do that all day long. And that is the right theoretical. And I remember a guy from the steel company coming in and we were like, oh my God, we had a case study about this. Here's what it was. This was our answer. And his thought was like, yes, that's true, but you have to realize that there are real world implications to doing that. Like for instance, okay, I sell at this price to this customer. Does that customer talk to this customer? Am I going to undercut what I'm doing there? Do I now lose out on opportunity to sell those materials to some future buyer at a higher rate? Like there are things that you have to consider. I still think in general the answer is yes. I think in general the answer is like you have to, if the choice is letting people go or finding a way to afford keeping them for some period of time, I think that's likely a better answer. But you really have to create some pretty solid fence posts around this particular opportunity. Ideally, I've seen a couple people. One client we were on yesterday, I can't remember what it was. You might have been there too. They had like an introductory price, like, hey, if we can start a little bit early, we'll cut 50% off the first month, some version of that.
Yeah.
Extend that over for a quarter, like an automatic accelerator up. Great. Short-term project, just so like you're not locked in to now eating up this person. Because it becomes like quicksand, right? Like you sell this one, then you sell this one, and all of a sudden now you're in like a margin neutral business forever and you're stuck. You cannot allow this like temporary measure to sort of like accidentally redefine what your agency does. That is the real risk, which is what the Steel executive tried to tell 21-year-old Ryan Watson way back when. But I think if you do it right, it can work. I don't know. You said you have opinions.
No,
You're
I agree with you. I agree with you. It's tricky and it depends. And it depends on how certain you are that it's a at least break even. Maybe there's a little bit of margin, but I think in a lot of cases it ends up not being break even. And so we did this for a loss, but it was cash in the door, which helped extend, payroll a little bit. And we kept people on. And in hindsight, maybe we should have just said, cut some people and said no to the project. So
well, totally. I mean, yeah, you're right. It presupposes all sorts of things. Because again, I mean, I'd say in most cases, again, I think we've had conversations. Almost 100% of clients have had to have some version of cost cutting considerations or whatever. That is the economic environment we live in. And almost in all those cases, it's like if we're coming to this objectively, we have some performance issues that we have to work out. We have areas of the business we thought might be an opportunity. It's pretty clear that's not really going to be an opportunity. We hired ahead a little aggressively. There's some natural business decisions that you have to make anyway, right? And so that is the first exercise.
yep.
Do we need to do these or not? And then the other thing, like I've seen some folks, this is not very easy to execute on, but if you can do it, it might work, is like, rather than selling an external project to a client, like just renting out a resource to another agency for a defined, like as a freelancer for a defined period of time. Hey, can you use this person on a project for a month as if they're a freelancer? That kind of solves some of the other
Yeah.
implications.
Yeah. I've seen that happen.
It's not necessarily easy. Unfortunately, in this environment, everybody's trying to do that. Everybody's got supply, not enough demand, but if you can make that work, yeah, that could be good too.
I have
Um,
another thing I want to get your opinion on, but Carolyn, do you have any other questions from the audience
Yes.
that have come in?
Sorry
And
to cut you guys short on that topic. We got a question in the live asking, many agencies have found the past year difficult. Do you see economic indicators pointing to things getting better or worse?
uh, well, Sonny, I was talking to shout out Carl from Bureau of Digital. I was talking to Carl earlier today about this topic because he's been talking to a bunch of agencies about this topic. And so I'll say what I'm saying, and then Meredith, I'd be interested in what you're seeing. But I think, well, first of all, man, it's really hard to answer the question of economic indicators. Are they going to get better or worse? I'm hopeful that we see rate cuts at some point this year, and that would be a positive thing. But in terms of like the macro economy, I think if anything, there's just like enormous uncertainty and volatility, right? The events of the last week, I think, have made that pretty clear. Really hard to estimate what's going to happen in the economic environment as it relates to like what's happening with agencies. It's really interesting. It's definitely like very bifurcated. Like we have a number of clients who are having a really hard year. Like as I've said, maybe even on this, I think 2023 is the year where we talked about economic hardship the most. 2024 is where we've probably seen the most economic hardship. Which is kind of surprising because there hadn't been as much like news or talk track about that. But there's definitely a subset of our agencies that have really struggled, and then another subset not struggling, doing great. Some having really solid. I can think of gosh, a half a dozen that are having, if not really solid years, really solid Q2s. Um, and those are, a lot of the kinds of criteria you would expect. They have a clear niche. They're a larger agency. They have more defined revenue generation engine, right? Like it's a more established business. I also think that and Meredith, you and I can think of a similar client. We often talk about like, where's your revenue coming from, new or existing, right? And one of the clients I'm thinking of the lion's share of having a good year, lion's share of the revenue is coming from existing. And I think that is true for the clients that are doing better. New logos are hard to get.
that's the theme of success this year is account management. The
Account
clients
management.
that are nurturing and developing current relationships and growing those are if we're going to say winners and losers, like they
Yeah.
are seeing more success there.
You can hang on. The people are still spending money. That's happening. Like people are still spending money. But people, again, like new businesses are dragging their feet at best on
Yeah,
creating new relationships. Those
yeah,
are hard to do right now. Nobody's in a hurry to add a
yeah.
new vendor.
Especially in the tech industry, like if you are out in the Bay Area working with anybody in the Silicon Valley, like that's been a lot more difficult in the
Yeah.
last 18 months than it was in the 18 months before that.
I mean, anecdotally, it was so funny. I was reviewing red lines for a contract a week ago at a swim meet for my son, and I remember thinking, "Oh my gosh, the first call we had with this procurement department, I was at a swim meet last year. Holy cow, we've been doing this for a whole 12 months. This thing isn't signed. What's going on?" This is what's happening. So anyway, all right.
Yeah.
Here, hey Meredith, what was the thing you wanted to get my opinion on?
Oh,
I don't know if you're.
a different subject, time tracking, everyone's favorite.
Oh boy, ooh, left turn. Okay, go ahead, keep
It is a
going.
lot. Is there
Go
anything
on.
else that you wanted to hit on, Caroline, before I jump into that? Okay. All right, so I have this client, they're time tracking, the employees are afraid of fully tracking their eating hours because they're so focused on their project margins or project profitability that the narrative is we've got to be profitable on our projects. And so therefore the employees are eating their hours. Like, how do you combat that with the team as a business owner? Like, how do you change that feeling on the team?
Yeah. Well, I mean, it's so hard. Like the problem, just to be clear, you're thinking of a specific example.
Yeah.
And is this like if these folks, so you're saying, oh, okay, they're going in the reverse. They're eating hours. They're working 40, but recording 20.
Yeah. And we're
Okay.
like, we've got to stop doing that. We need to be able to, because when we're scoping for new work, we need to be able to see how much time is actually going into the project. And there is just
Well,
an overall fear from the team of like, oh, I don't want it to look bad. So I'm
well,
gonna
yeah,
try.
it's clear the incentives are messed up, right? Obviously we've created the wrong incentive structure for people to feel because so yeah, we've clearly said project margin good and you know alternative bad, right? So because I believe that the natural state of a person would be to record their hours accurately, both just because that's the thing that takes less brain power, and also because that's the thing that's in their self-interest. You know what I mean?
Right.
Like to be honest about whether they're busy or not is in their self-interest. Eating hours is just going to result like in me giving you more work and thinking, oh, you can take two more clients, and then you're up to 80 hours and you're only recording 40 or whatever it is. So, I mean, this isn't like a miracle answer, but clearly we've communicated the wrong thing to these individuals, and we need to backtrack on that, which is yes, for sure, we would love to get a good project margin, but like we've got to earn it for real and not like fake. This doesn't do us any good to pretend like we are. I do think, it's so funny. We obviously grew up in public accounting, and that was a big thing in public accounting. So we used to eat hours all the time. I remember hearing the whole thing. I do think people who hour eaters, I think they think of this as like a victimless crime
Yeah.
because it's like, well, who cares? You're paying
Yeah.
me the same rate whether I'm doing the work or not. What does it matter?
Yeah.
And so I do think they're just missing, like, there's an information asymmetry here. They don't understand what the implications for this are and why we need them to be honest. And hopefully we can just sit folks down and say, sure, I would love a good project margin, but I would rather a bad project margin with good data
Yeah.
than a good project margin with bad data. Like, I mean, like, I just need to know the answer. We'll fix whatever it is. It's not doing me any good. If you think you're helping me, you're not, and you're certainly not helping you.
Yeah.
So who are we doing? What are we doing? Stop. I don't know.
But
Is
yeah,
that,
that's where my head was at. That's what I
yeah,
said.
yeah.
Yeah. Yeah. Okay. These are all
Okay.
you're
These
getting
are all
all
the hard hitting things. Yeah.
thoughts that were happening in my head this week that I wanted to debrief with
That's
you.
why we're here. That's why we're here. Okay. Caroline, Is that it from the gallery? That's it for the gallery? Okay, well, I think that's it on our time as well. So for those of you that have been here the whole time, thank you very much. Hopefully you got some value here. Thanks for those of you that sent in your questions ahead of time or dropped your questions in the comment. As a reminder, we do this every month. So we will be, what is it, the third Thursday, Caroline? We will be back here the third Thursday at 2 p.m. Eastern. Same crew answering all of your burning questions. So meet us back here then. In the meantime, follow us on LinkedIn, subscribe to our channel on YouTube, and send ahead any questions you want us to answer.
Cool.
Until then,